Hello and welcome back to the channel. If you're joining us for the first time, please consider hitting that subscribe button and ring the bell icon. This way, you'll stay updated with our daily insights designed to help you navigate the world of finance. In today's video, we're diving into digital money mystery. Why is transferring funds still so complicated? Get ready to uncover the hidden challenges and surprising truths behind our digital financial system. And that's not all. Stay with us until the end to receive 2 exclusive bonuses, 10 key takeaways, and 10 exercises that will demystify the complexities of digital money movement. Curious to find out why something so essential is still so complicated? Let's get started. Imagine a world where trading an apple for an orange isn't just a simple swap, where the value of what you hold isn't just in the fruit itself, but in what it represents. Welcome to the complex tale of money's evolution, from tangible goods to digital digits. The early days of trade. In the beginning, we traded goods directly. I had an apple, you had an orange, we swapped, simple. But as our needs grew more complex, so did our trades. Enter the clay balls carved with symbols, each representing a promise of fruit in the future. The birth of banking. Fast forward, and we've got banks. Not just any banks, but ones that store your fruit credits and even pay you to keep them there. Sounds perfect, right? But here's where it gets tricky. A watermelon farmer needs credits for an irrigation system. The bank loans the credits with the promise of more in return. Everyone's happy until they're not. The complexity of modern money. Here's the kicker. As we deal in bigger numbers and add more players, the original simplicity of trading fruits fades away. Banks now create money out of thin air. You deposit 1,000 credits, they loan out most of it. But on paper, everyone still has their full amount. It's magic. Financial magic. The evolution of currency movement. By 1867, moving money was still a drag. Each bank printed its own money, and that money was a hassle to use anywhere else. Fast forward to checks, still a pain, especially when banks don't use the same system. Then came the modern era of banking with computers and electronic transfers, simplifying things somewhat. The rise of digital transactions. Today, we've got the automated clearinghouse and SWIFT, making sure money zips around from one account to another across states and even continents. Yet, with all this tech, transferring money can still be surprisingly complex and costly. Fintech revolution. Enter fintech startups like Wise, slashing fees and bypassing the old, cumbersome systems. They're not just changing the game, they're rewriting the rules. But even in this digital age, the integrity of transactions remains crucial. One mistake, and the whole trust system we've built could crumble. Reflective question. Money has evolved from fruit to clay balls to digital codes. It's become mostly abstract, a far cry from its tangible roots. Yet, it all boils down to trust in a system where physical and digital worlds collide. How we manage and move money continues to shape our economy, our businesses, and our lives. So the question remains, if money is now mostly digital, why is transferring funds still so complicated? Why is transferring funds still so complicated? Despite the technological advances that have revolutionized many aspects of our lives, transferring funds remains a complex process. Here are the detailed reasons why. Legacy systems. Outdated infrastructure. Many financial institutions still rely on outdated legacy systems that were built decades ago. These systems were not designed for the speed and flexibility required in today's digital economy. Interoperability issues. Different banks and financial systems use various protocols and standards, making seamless integration challenging. This lack of interoperability requires complex intermediary processes to ensure transactions are correctly processed. Regulatory requirements. Compliance and security. Financial transactions must comply with stringent regulatory requirements to prevent fraud, money laundering, and other illegal activities. This includes Know Your Customer, KYC protocols, anti-money laundering, AML regulations, and transaction monitoring. Cross-border regulations. Transferring funds internationally involves navigating the regulatory frameworks of multiple countries, each with its own rules and compliance requirements. This adds layers of complexity and slows down the process. Security concerns. Fraud prevention. Ensuring the security of transactions is paramount. Financial institutions implement multiple layers of security, including encryption, multi-factor authentication, and real-time monitoring. These measures, while essential, can slow down the transfer process. Cybersecurity threats. The constant threat of cyber attacks forces institutions to adopt robust security protocols. The need to secure every transaction against potential breaches adds complexity to the process. Intermediaries. Multiple parties involved. Fund transfers often involve multiple intermediaries, including correspondent banks, clearinghouses, and payment processors. Each party in the chain adds time and complexity to the transaction. Clearing and settlement, clearing, the process of updating accounts, and settlement, the actual transfer of funds, can take time, especially when different time zones and banking hours are involved. This is particularly true for international transfers. Fees and costs. Transaction fees. Banks and payment processors charge fees for their services. These fees can vary widely and are often not transparent, adding to the complexity and cost of transferring funds. Exchange rates and conversion costs. For international transfers, currency exchange rates and conversion fees can significantly impact the total cost. The fluctuation in exchange rates can also introduce uncertainty and delay. Technological limitations. Batch processing. Many traditional banking systems still use batch processing for transactions, which means transfers are processed in groups at specific times rather than in real time. This can delay the completion of fund transfers, system downtimes, and maintenance. Regular maintenance and unexpected downtimes can interrupt the transfer process, causing delays and inconveniences. Lack of standardization. Diverse payment systems. There is a lack of global standardization in payment systems. Different regions and countries have their own preferred payment methods and systems, which may not be compatible with each other. Varied financial instruments. The range of financial instruments and transaction types, e.g., wire transfers, ACH, SWIFT, and digital wallets, adds to the complexity as each has its own processing rules and timelines. Fintech innovations and future trends. While these challenges persist, fintech companies are making strides to simplify fund transfers, real-time payments. Initiatives like faster payments in the UK and the clearinghouse's RTP network in the US aim to enable real-time fund transfers. Blockchain and cryptocurrencies. Blockchain technology promises to streamline and secure transactions by removing intermediaries and providing transparent, immutable records. Cryptocurrencies like Bitcoin and Ethereum offer alternative means of transferring value without traditional banking systems. API integration. Open banking and API integration allow for better interoperability between different financial systems, enabling more seamless transactions. Despite these advancements, achieving a universally seamless, instant, and cost-effective fund transfer system remains a work in progress, as financial institutions continue to balance innovation with security, compliance, and reliability. Bonus 1. Here are the 10 key takeaways from the video. 1. Legacy systems slow down transactions. Many banks still rely on outdated systems, making integration and speed a challenge. These legacy infrastructures weren't built for today's fast-paced digital demands. 2. Complex regulatory environment. Stringent regulations like KYC and AML are necessary, but add layers of complexity. Cross-border transfers face even more regulatory hurdles, slowing down the process. 3. Heightened security measures. Robust security protocols to prevent fraud and cyber attacks add to the complexity. Multi-layered security checks are essential, but can delay transactions. 4. Multiple intermediaries. Transfers often involve several parties, each adding time and complexity. Clearing and settlement processes are not instantaneous, especially across time zones. 5. High fees and costs. Transaction fees vary widely and can be opaque, complicating the cost structure. Currency conversion fees and fluctuating exchange rates add to the overall cost. 6. Technological limitations. Many systems still use batch processing, delaying real-time transfers. System downtimes and maintenance can interrupt and delay fund transfers. 7. Lack of standardization. Diverse payment systems and financial instruments create compatibility issues. Without global standards, transferring funds across different systems remains cumbersome. 8. Fintech innovations offer hope. Real-time payment initiatives and blockchain technology promise to streamline transfers. Fintech startups like Wise are reducing fees and bypassing traditional systems. Open banking and API integration improve interoperability and transaction efficiency. 9. Trust and integrity are crucial. Despite technological advances, maintaining trust in the system is paramount. Ensuring the integrity of transactions is vital to prevent system collapse. 10. Future trends show promise. The financial industry is evolving with real-time payments and blockchain solutions. Continued innovation aims to make fund transfers faster, cheaper, and more secure. Bonus 2. Here are 10 exercises on how to implement the takeaways. 1. Legacy systems slow down transactions. Research the history of a major bank's technology infrastructure. Identify key points where they upgraded their systems and discuss the impact of these changes on their transaction speeds and efficiency, and share in the comments. 2. Complex regulatory environment. Create a flowchart outlining the steps required for a cross-border transfer from your bank to a foreign bank. Highlight each regulatory checkpoint and explain its purpose in the context of financial security and compliance, and share in the comments. 3. Heightened security measures. List the security measures your bank uses for online transactions. For each measure, explain how it protects your funds and what potential threats it mitigates. Share your findings in a short presentation and share in the comments. 4. Multiple intermediaries. Simulate a fund transfer involving multiple intermediaries. Role-play with friends or colleagues, assigning each person a role, e.g., bank, clearinghouse, correspondent bank. Track how the funds move and the time taken at each step and share in the comments. 5. High fees and costs. Compare the fees and costs of transferring $1,000 internationally using 3 different methods, e.g., traditional bank transfer, fintech service like Wise, and cryptocurrency. Analyze the differences and determine which method is most cost-effective and share in the comments. 6. Technological limitations. Investigate the batch processing schedules of several banks. Choose a bank that uses batch processing and monitor a transfer you initiate. Document the time it takes for the transaction to complete and discuss how batch processing affects the timing and share in the comments. 7. Lack of standardization. Identify 3 different payment systems used globally, e.g., ACH in the US, SEPA in Europe, UPI in India. Create a comparison chart showing their key features, benefits, and drawbacks. Discuss how these differences impact international fund transfers and share in the comments. 8. Fintech innovations offer hope. Research a fintech company that is revolutionizing fund transfers, e.g., Wise, Revolut, or Ripple. Prepare a case study on their technology, business model, and the impact they have had on traditional banking systems and share in the comments. 9. Trust and integrity are crucial. Interview a financial expert or your bank's representative about the importance of trust and integrity in financial transactions. Ask them to share examples of how breaches in trust have affected customers and the bank's reputation, and share in the comments. 10. Future trends show promise. Write an essay predicting the future of fund transfers based on current trends in fintech and blockchain technology. Include potential challenges and how they might be overcome. Support your predictions with current data and expert opinions, and share in the comments. Do you know the 12 rules to unlock your financial life? Click on the screen and see Unlock Your Wealth. 12 surprising money rules you aren't following yet. See you there.